Good day, fellow investors. Now, many growth stocks are really in the dumpster, which means that we value investors start looking for value even with growth stocks. Because don't forget that growth is an essential part of value. There is no differentiation there, value, growth. Anything can be value if bought at the right time. So let's look at 5 businesses today that have been hit pretty badly and see whether there is some value for value investors. If we just look at these stocks, Airbnb year to date down 43%, Spotify year to date down 56%, Zoom year to date down 34%, and Netflix down 68% year to date, plus PayPal also, if we look at year to date, down 61%. Over the year from the peak, those companies are down around 75%. So let's immediately start with Airbnb. Plus, I want to add here that all of these companies I am partially or somewhere related to. So I am a customer, or I use those services, or my family uses those services. So these are companies that are pretty much well entrenched in our lives, which is an essential part of value investing. You want certainty, you want stability, you want something that is already there, not promises for the future, something that is there. And all these companies, I used Zoom a few days ago, so all these companies are in our lifestyles. And let me know in the comments if those are in your lifestyles, and let me also know about other companies that you are using that are down 75% or might be offering value, because that's always something interesting to learn, and we will all learn from the comment section. Let's start with Airbnb. So they don't have a proper investor presentation, which is a shame, but they do things differently. So we have the shareholder letter that gives us good insights. So 300 million nights and experiences booked in 2021. Q1 of 2022 has already seen 70% growth. So I expect this to maybe even go to 600 million in 2022, especially with the summer and going away from lockdowns. On that gross booked revenue, we have 6 billion of actual revenue for Airbnb. By the way, how am I a user? My wife used Airbnb 5 years ago, but my family has some apartments and they have it also on Airbnb, but also on all other providers like Booking or and something. So there is a lot of competition, that is a certainty, and we will have to see how and where does this company stabilize over time. Now, when it comes to business highlights, this is something that I always watch for. Okay, they are really discussing the business, but what do I care whether guests are living on Airbnb or not? That is just maybe 1% of, or 0.1% of the story. Okay, it makes a cool thing, but I don't want to invest in cool things. I want to invest in profits. And if we look at the quarterly revenue now with lockdowns going away, we see a 70% jump. I think this could be even 100% jump for this year. And unfortunately, they are still making losses despite the jump in revenue. Okay, barely profitable. So EBITDA pretty positive, which is okay, but this is what matters at the end. And with the balance sheet and cash flows, I don't know how they account for the payments in advance and then they have to pay the suppliers of the apartment. So that's something to watch. But it looks like a stable business now, growth, it has some strength, it is entrenched in how we live. However, when it comes to future growth, I really like to watch this. So if we look at Google Trends, of course, Airbnb, when it started, slow growth, but we can see that it has peaked somewhere around here and then started, okay, going down these seasonality, of course, COVID, and now it has returned to here, but how much more room for growth? It has stopped growing as fast already here. It is a very competitive market, so I'm thinking that, okay, growth might be there ahead, but how much do I need it when compared to the stock price? If I look at the stock, of course, recent IPO, I remember everyone saying, Sven, you are stupid not to enter the IPO Airbnb. This was the time when you bought an IPO immediately and then you found yourself 50% up just in a moment, in the same day. Well, those times have passed and Airbnb is now below the IPO price. Nevertheless, we are at a market cap of 62 billion, which is what we have to use for valuation. And if we look at valuations, market cap 62 billion, 6 billion in revenue, likely to be 12 billion in 2022. But what then? What after 2022 is my question. For now, at 2022, 12 billion, we are 5 times sales and likely no profits with questionable growth ahead. Because I don't know whether they will keep growing 20-30% ahead or the market is saturated with all the bookings, with all the these and that, and so much pressure on these things online and everywhere. And most of those that offer apartments use everything and then they combine it. So that's also something that there is no exclusivity. It is possible, anything is possible. But there is always the risk, because this remains then a growth story. To justify its valuation on some normal profits, it needs to grow 10 times to justify the current 60 billion. Will it grow 10 times over the next 10 years, 20 years? Very, very hard. Will scale ever be reached? They need to spend on advertising, on this or that, compete with prices, with offerings. So that's always a question. And then when it comes to valuing this, when you see this 10 times required growth to justify the market cap, let's say, high competition, then you know it is still a venture capitalist bet. Venture capitalist bets are not really value investments. Maybe Airbnb for the infrastructure and everything will be a value investment at 20-30 billion when someone else, someone bigger will say, okay, that's very interesting, let's buy. Let's say an Amazon goes in and takes and enters the market and then builds on its ecosystem and scale. That's also very interesting. At 60 billion, perhaps a little bit too much, but for now, I don't see a margin of safety and certainty because of the high competition ahead and questionable growth beyond 2022 and 100% growth. Now, let's go to a company that's more interesting than Airbnb from a value perspective. And even my mother said that Spotify was one of the best investments in her life because she really loves the music and listening to it while she works, etc. So we have a customer. I'm not subscribed to Spotify, but my mother is, so that's equal. And let's look at the stock, down 56%, down 58% over the year. And since it was listed, it is again another one down below the IPO price. And we can see here that the market cap is 20 billion. And okay, PE ratio, that's irrelevant now. We have to see the potential of these companies. So 20 billion, already a third of what Airbnb offers. And let's now look a little bit at the business. So global business, they are also scaling globally. Now I looked at this churn rate and I thought, okay, that's very low churn rate, 8%, especially for digital businesses. But then I saw that it is a monthly churn rate, which then tells me, okay, interesting to follow. That's likely normal in the business. Some have more, some have less, but they are calculating for good lifetime value and the probability of customers going away. And those are pretty sticky for Spotify. Expected gross profit on the customer over the years is pretty good, and that also gives net present value. So lifetime present value is 67 euros, as they are Swedish, no? So 67 euros times 400 million people, and you get to a good present value, much higher than the market cap. And their plan is to increase the number of users by 2x over the next 10 years, and then do something even more important, and that is increase the average revenue per user 4 times. If they can do that, that would be really big, because that would increase revenues 8 times, and they plan to do by more music, podcasts, and new verticals that they can expand on their ecosystem for 8 times revenue growth. They are strong in India. They have been gaining market share, as you can see in India, and don't know what the pricing is there. I know Netflix has a lower price tier there, but Globally, users are still growing. Okay, this will likely slow down as people are not at home anymore listening to music, but maybe when they go to work, it's always nice to listen to something. Better listen to YouTube, but okay. 3 times ad revenue, podcasting growth, comparative average revenues per user. So they see higher average revenues potential there, therefore the 4x there. But I'm always wondering, can they keep their market share, which is pretty high? And then also with the new ventures, new ideas, we don't know how that will work. For now, historically, they have been able to grow 26%, which is good. They have positive, strong free cash flow, so they are not in trouble no matter what. And that's also another sign of value, something that I would say it's less risky than Airbnb because they can finance themselves pretty easily. And balance sheet, okay, they will use the strength for expanding the business, increasing the value of the customer, and also share repurchases. The goal is to generate 100 billion in revenue and 20% operating margins, thus 15% net profit income. And if you look at that, that's 15 billion in profits. And if you compare that with the market cap 10 years from now or 8 years from now, that is a price earnings ratio of 1. So if they succeeded from this base of just 20 billion, I think that if they make 15 billion in profits, this will be a 200 billion company and you have yourself a 10x. If they manage to work on their plans and succeed. So for now, everything looks good, the margins, everything. So if they do 10x revenue, they are now at the P ratio of 1.5. Let's be conservative, let's keep it at 2, which is really remarkable. The company is stable, scalable, and if they can really go into that business and increase the revenue per user and double the number of users, then they will really justify the investment and make this now a value investment. When it comes to value investing, and me personally, I think the risk and reward looks interesting now with Spotify, but I'm a value investor. I want even more certainty. I want a margin of safety. And if competition comes in, if you listen more to YouTube, less to Spotify, I see that place being really crowded. I get 5 emails a day saying you should do a podcast here, podcast there, this, that, collaborations, that, boom. So really fierce competitive environment. Therefore, I don't know whether someone will win or everyone will win with low profits. And we as content creators, we go where you go, not where Spotify wants me to go. So there will always be ups and downs, which makes it a little bit too risky, but compared to Airbnb, for example, less risky for maybe equal upside. Now, the absolute bargain in this group, because it is a 15x certain according to ARK Investments. So ARK's expected value for Zoom video communications in 4 years is 1,500 per share. Based on their Monte Carlo simulation, don't forget Monte Carlo is just a casino and that's it, in a small country in Europe. They don't know what the Monte Carlo is, and you can't just put 38 inputs in it and look at the results based on what you want to do. So this is ridiculous, but just look at their expectations and what is priced in that estimation. So real strong growth, especially on remote knowledge workers, global hybrid working, and expecting that almost half of that population will be using Zoom. A little bit less, 40% of that population will be paying Zoom users, and therefore they see really a boom. Now, I used Zoom last week. After 40 minutes, I was simply sent a new invite because I know I'm not going to use it long term, just when I need it. And therefore, you also see the paying users now, and they're using Zoom remote workers, and they see that increase in paying users and higher average revenue user per share for great revenues, high extreme margins with no costs, high profits, and then a market cap going 20 times higher. Also the share price 20 times higher. Now, this can happen as always, but as we discussed also with Tesla and my projections there, this is a video I made a year ago, and there were many comments attacking me everywhere because first I said that Monte Carlo can't be used in the way they are using it, and that I prefer elementary school maths like Charlie Munger, like Warren Buffett. You don't need complex maths to do investing. You just look, this is it, what's the price, what's the return, and that's it. When you start doing shenanigans with Monte Carlo things, then you are trying to trick something, then it's marketing, then it's not real investments. Let's look at Zoom from what it is now. So we see slower than expected growth. Okay, 12%, that is good growth in revenue, but Zoom really boomed in the pandemic times, and now it is not growing as fast as earlier, and that's also the reason why the stock is down significantly over that period. So if we look at the peak to now, we are 70% down. The market cap is 36 billion, as the market doesn't see the growth it used to see just, what is this, 2 years ago. So it didn't reflect into profits. The growth is slowing down, and that's why you see that a little bit. Okay, it is there. Revenue is 1 billion for the first quarter, just 12% growth, not 20, not 30, 12%. And now they expect higher growth in the future, but the question is, will there be higher growth? We are using that. They have the potential there. They are having free cash flow, so nothing wrong there. And they expect earnings per share of around 3.7 for this year, which is good. It gives you a price earnings ratio of around 40, 45, 50. So if they keep growing, that is not bad. However, also keep in mind something here. When they calculate the earnings per share, they have stock-based compensation that is 20% of revenue in Q1. It was 10% of revenue in Q1 2022. That is huge stock-based compensation. So I'm thinking, wait, this is a little bit too much, and that really also skews the general accounting accepted principles net income and the adjusted non-GAAP net income, because there is a big difference between what they actually do and what they present. So always watch that, which is something I don't really like, because this means the management is really focused on themselves first, and then the rest is, okay, if it happens, good. If not, who cares? I made my 212 million in Q1 2023, or 20% of sales. And you can check more here the reconciliations and how they are doing. And we can check here the cash flows. So investing activities are high, so not much into PP&E, but they have to do acquisitions to grow. And here there is again something that I don't like, for example. So the new metrics are enterprise customers, because those metrics are still growing. All the metrics previous used are customers with more than 10 employees. Those metrics are going down, so let's use some new metrics, new focus, switch. And again, something that doesn't make me really sure that Zoom will pass the long-term smell investing test, because we just look at, okay, are you trying to trick me? 20% of revenues for stock-based compensation is a lot. Now, when it comes to investing, 1 billion, 4 billion, let's say, revenues over the year will likely grow to 5 billion. So we are at price to sales of 6, and how much do they need to still grow for justifying the current market cap? So at least 5 times, and you're not going to grow 5 times with 10-15% growth ahead. Plus, the competition is fierce. Microsoft Teams, Amazon, when there is more need for this, all these companies will provide this service alongside the package. So I'm thinking big companies that can provide all the needs from cloud, from this, from that, compared to Zoom, that is just one thing. So they will likely have to merge with someone, be bought by someone. So that's now the question is, okay, at what price is Zoom a buy for somebody else? I know that Microsoft was interested, but then the price was too high, and then they developed their own teams, and then now they don't need it. Who else could buy this to integrate it? 36 billion might not be a crazy thing to integrate Zoom with something else. So for a big company, for a Facebook, but they can then build their own tool too. And there is always competition, and it's very, very quick to switch to something else. I don't remember the last time I used Skype, but Skype was the name of the game 5, 6, 7 years ago. So these things change. It's hard. We expect these things for free. It's hard to just go and pay no matter what. Yes, business users, but business users also, they are not growing as fast as they did. So for Zoom, a little bit too risky, too much snake oil, too much ARC type to the moon for me, so I'll pass on that. Still, I would put it in a risk basket like Airbnb there. For now, Spotify looks the winner. Now, Netflix. We have discussed Netflix when Bill Ackman bought and sold. We made a valuation for it, and I also discussed it in the only short I made. Let me know if you want more shorts. I'll try to focus on that too, where we discussed that the competition is huge. They are investing $1,000 per home, and they expect with the margins, profit margins, to make 50, 100, which is impossible because of their thin margins, because of the wars on content, which is something to think about. If we go to our intrinsic table, where you can find all the analysis that we made in the past and more, we also have now the YouTube portfolio that we recently launched with a new buy that we'll discuss soon. And if we go here, we have Netflix here, and yes, from a value perspective, the free cash flow is 5 billion if they can reach it. If they can stop spending on content and just grow a little bit faster, then if they can reach that 5 billion, 25 billion in profits and 20 billion spent on content, that's 5 billion in cash flows, but they have to reach it. And this was the idea behind likely Bill Ackman purchase, but given the content war and the constant need for content and the fact that you are actually trashing the content, there is not more value after a year. Squid Game, okay, was interesting. Look at Google Trends. Now it isn't anymore. So you spend a lot of money, but you need to spend more and more into new things to be profitable there. So if they make 5 billion stable, then the intrinsic value is, yes, 90 billion, which means that Netflix is now fairly priced for a 10% return. So for a 10% return, they need to grow 10% ahead, have a price earnings ratio of 20. But if they grow at just 6%, keep in mind, this assumes that they reach profitability, then the present value is already much, much lower. And the key question here is, will they reach ever that profitability? For now, everyone is attacking that streaming industry, extreme investments in content with $10 a month that they get, which means that the margins there are really skewed, and everyone is playing for the game, winner takes it all. Again, maybe in the sector there won't be a winner. We will have a lot of content for pennies on the dollar. We as customers will gain. The streaming industry maybe scale over time, but it's a big difference if you value Netflix, whether they reach 5 billion tomorrow, this year, or 10 years down the road. So if I delete the 5 billion here, or let's put 1 billion for growth, and then let's say that they reach 5 billion in profits only in 2031, then the intrinsic value is just 18 billion. So really, really not that much. We multiplied here. So then we have to go 30-60% down from the current market cap, which makes it risky. Now, another company that we analyzed is PayPal, and it was 126, where you all attacked me that it is a great bargain, it is a value buy, and I said it's not a bargain for me because of the negative trends in the industry. And fortunately for me, unfortunately for you, I was pretty okay with the call there. Now, Doesn't matter, that's irrelevant. You can be right, wrong, it is irrelevant. What I care about is the business. The market cap is 86 billion and the free cash flows were around 6 billion if I remember correctly. So PayPal is here, the table is here, earnings per share in line with free cash flows to catch them when it comes to investing. And if we put a growth rate of 10%, 7%, terminal multiple of 20, then the intrinsic value per share is around 70. So we are close to it for a 10% return. However, if the growth rate is just 4% and 2%, then the present value is just 22, so another 60-70% down. And I am using PayPal. If you want to buy my research platform, I think you can pay also with PayPal. However, I am personally switching to Stripe, which gives me no fees, less fees than PayPal, which makes things much better for me. So that's the competition there in the sector. It's extreme. Everyone is running after you and giving you better, faster and cheaper. And therefore I'm looking at PayPal. Yes, it is interesting. It has this legacy business for 20 years of building very easy, but things are getting more expensive, more competitive, especially with Apple Pay, with this, with Google Pay, with that. Everything is going very, very fast. And I don't know whether they will keep on growing forever. So if that turns around, I don't know, like Western Union, this can forever be a bargain, look like a bargain, but it actually isn't. And then something else I want to discuss here. If you look at Vanguard investment funds, the fee there for your investments, for distribution into 500 companies, for everything, 0.03% per year. PayPal for a transaction takes 3%. So I'm thinking something is wrong there, and when you think something is wrong in the sector, somebody will go after you, after the 3%, because they will make money with 1%, half percent, 0.03%. And that's the disruption in the world there. Someone will disrupt it, will go after it, will make it more frictionless, cheaper, and that's the risk I see in PayPal. That's why I'm not investing in it no matter what. So what is a buy? For me personally, I need margin of safety, I need more certainty. So Airbnb, okay, but is there room for fast growth to justify current price? That's the risk. Spotify looks good if they can continue growing on their plans, 26% per year. We will see. For now, they have managed, but again, a venture capitalist bet on future growth. Zoom, huge competition. Netflix, content wars. PayPal, again, competitions. So for me, a little bit too risky despite the 50-75% crashes. Hope I gave you a good perspective here, my perspective, and we'll just keep on doing what we do with our portfolio that you can also check here on the table, and also to the link to the video that we make discussing it. You can check also why, and Berkshire is coming soon, no worries. So no buys here. For me, still too much risk in that growth. Anything can happen. All of these stocks can, yes, 5, 10x, that's possible, but when investing you need a margin of safety because that is what makes you rich. Thanks for watching. If you're interested in what I do, check my research platform, check our YouTube portfolio that we have started on a value investment basis to learn more about businesses. Like, subscribe, and I'll see you in the next video.